the public deposit, it means that the deposits that are raised by organization directly from the public, that you are raising money from the public by giving them amount of interest. The interest offered on the public deposit are usually higher than that offered with the bank. When you are taking from the public, the interest rate will be more than what is offered by a bank. Person who is interested in depositing money in an organization can do by filing up a prescribed form. By signing a prescribed form, you can avail loan from public deposit, but the interest rate is higher. Its merits are the procedure for obtaining the loan is simple from public deposit is simple and does not contain any restrictive condition. Then cost of public deposit is generally lower than cost of borrowing from banks and institutions. The cost involved is less. Then the public deposit do not usually create any charge. There is no charge on asset. And depositor do not have voting right. The control is not diluted. So depositor do not have any voting right. Coming to the limitation, it means new companies generally find it difficult to raise funds through public deposit. It is an unreliable source of fund, that is, public may not respond when the company needs money. So it doesn't take like it will match. We cannot say that it will match. When you need money, you will get it. It is not sure. It is unreliable source. Then collection of public deposit may prove difficult, particularly when size of deposit required is large. Then collection will be difficult. Next is commercial paper. Commercial paper emerged as a source of short-term finance in the country in the early 90s. Commercial paper is an unsecured promissory note issued by firm to raise funds for a period varying from 90 days to 364 days. That is, for this much period you have to repay it. So therefore that's why you are issuing commercial paper, and you can issue this and you can take money only for a period 90 days to 364 days. Actually, the amount raised by issuing commercial paper is very large. So, coming to the merits, it is commercial paper is sold on an unsecured base and does not contain restrictive condition. It is not restrictable, it is freely transferable and provides more funds compared to other sources. Then it can be a continuous source of fund. Then companies can park their excess funds in commercial paper, thereby earning some good return on the same. They can get good return. Next, limitations. Only financially and sound high firms can raise money. That is, a good position company can only raise such money from issuing commercial paper. Then the size of money can be raised through commercial is limited to the excess liquidity available with the supply. That has a limit. Next one is commercial paper is an impersonal method of financing. That is impersonal. It's not a personal method. It's impersonal method of financing. Next one is issue of shares. A company can issue shares for raising money. So capital obtained by issue of shares is known as share capital. The capital of a company is divided into small units called share. That is, for example, if there is 1 lakh shares of rupees 10 each, then the value will be 10 lakh. So you are dividing it to rupees 10, that is of 1 lakh shares, and you are offering it to the public, and you can receive money from those who are buying your shares. So there are normally two types of shares, that is equity shares and preference shares. Money raised by issue of equity is called equity share, whereas if it is issued of preference shares takes place, then it can be preference share capital. If equity share is issued, then it is known as equity share capital, and issue of preference share will lead to increase in preference share capital. Equity share is the most important source of long-term capital by a company. That is, it represents the ownership of a company, and thus capital raised by issue of the share is known as ownership capital of the owner's fund. This equity share is the most important source, and it represents the ownership of a company. That means when you are buying an equity share, because then it is like you are the owner of the company. Its merits are: it is suitable for investor willing to assume risk for higher return. If you are capable of bearing risk, then it is good for you. And payment of dividend to equity shareholder is not compulsory. Payment of dividend is not compulsory. You can save that much amount. Equity capital serves as permanent capital. It's a permanent capital, and it can be only repaid at the time of liquidation. You have to pay that only at the time of liquidation. Next is it provides creditworthiness to the company and confidence to loan providers. Funds can be raised through equity issue without creating a charge on assets. There is no creation of charge. The democratic control over management of companies assured due to voting right. There is voting right for electing the board of directors, and such advantage is there for equity shareholders. Coming to the limitations, then investors who want steady income, they cannot prefer such equity shares. Then the cost of equity share is generally more. Then issue of equity share dilutes voting power. That is, when you buy an equity share, you are again becoming the owner, then you will have power. So dilution of powers take place. Then more, it is a formal and procedure delays are involved. Next is the preference share. So equity share means they are becoming the owner. Capital issued raised by issue of preference share is called preference share capital. This capital raised by issue of preference shares called preference share capital. Preference shareholder enjoy preferential position over equity share in two ways. That is, the preference shareholders have two benefits. That is, they will receive a fixed rate of dividend. But in case of equity, it is not necessary that they will get. We cannot say that they will get dividend. Sure, there is no surety. So here they will be getting net dividend from out of net profit. Then its merits are. It is reasonably steady income. You can receive a steady income in the form of a fixed rate of return. Then that is, you are getting dividend at a certain percentage. So it is fixed. Then the preference share are useful for those investors who want fixed rate of return. So for investors who want fixed rate of return with a low risk, they can use this. Then it does not affect the control. If it is equity share, then it affects the dilution. It will lead to dilution of ownership. So here such dilution doesn't take place. Then permanent payment of fixed rate of dividend to preferred shares may enable a company to declare higher rates of dividend. Then preference shareholders have a preferential right, that is repayment over equity shareholder in event of liquidation of a company. Preference capital does not create any sort of charge against the assets of company. Then the limitation side is not suitable for those investors who are willing to take risk and interest in higher return. So if you are not willing to take risk, then you can use this preference share. No, that means the preference shares are not suitable for those investors who are willing to take risk. So if you are if you want to face risk and you need to make higher profit, then this type of share is not suitable. So preference capital dilutes the claim of equity over the assets of the company. Then the rate of dividend on preference share is generally higher than rate of interest on debentures. Preference share have a higher rate of dividend rather than the interest rate of debentures. Next is debentures. The debentures are important instrument for raising long term debt. You need cash for long term, then you can issue debenture. So through the issue of debenture you can raise fund, and this debenture will carry fixed rate of interest. So you have to give them interest. The debenture holder will get interest. The company issues debenture and the public can buy the debentures, and in return they will receive interest. The company will receive enough money. Coming to commercial bank, as we know that availing loan and much other facilities, you need to go to a bank for availing these facilities. So commercial banks occupy a vital position as they provide funds for different purposes for different periods. So they extend many types of loans, like it can be small for a long term or short term, then overdraft facility, term loans, discounting bill, issue of letter of credit. Then the rate of interest charged by banks depends upon weights. That is, different bank will have different interest rates. Then merits are like a bank provide timely assistance, then secrecy can be maintained, then formalities of issue and prospect underwriting are not required. That is, if you are having a good credit worthiness, then you can avail loan. Then the flexible source of finance. And coming to the limitation, that is, for funds are generally available for short periods and extension renewal is uncertain and difficult. That is, it can be available for a short period. For longer period, you need that much higher withstanding position. Your company should be that profitable. Then banks may detailed investigation of the company's affairs. So they will look into your affairs and financial matters, because they need to know that whether you are capable to repay the money. Then at sometimes the difficult terms and conditions are imposed by the banks for granting loan. That is, you have to accept some conditions that they are not maybe not good for you, but you need to accept that in times of difficulty. So that can lead to some problems for normal working condition, it will be creating problems. Which is financial institutions. The government has established a number of financial institutions all over the country to provide finance for business organizations. So the government has set up many institutions for providing finance to this business organization. So these institutions are established by central as well as state government. So they provide both own capital and loan capital for long and medium term requirements and supplement the traditional finance agents like commercial banks. So that is they are also called as the development banks because they provide for development of the country, industrial for development of industry, for industrial development of a country. These banks can be helpful. So they help for the development of that. That's why it is known as development banks, because they promote for the industrial development of a country. Such type of institutions are known as financial institution, which is established by the government. So its merits are like you can avail long term finance, which are not if you are not getting such finance from commercial bank, you can avail from financial institution. Then besides providing funds, it provide financial and managerial advice and consultancy services. Then obtaining loan from financial institution increases goodwill of the borrowing company. Then repayment of loan can be made in easy installments. Then funds is available when in the case of depression, that is when the economy is in crisis. Next, we are coming to the limitations. It is rigid criteria. You have to follow rigid criteria. Too many procedures have to be there. Then restrictions are there. Then the financial institution may have the board of directors. They restrict the powers of the company. Such kinds of limitations are also found. So every type of source of fund, every source of fund will not have negative positives only. It will have some negatives also. Every good thing will have a negative and a positive side. The next is international financing. So what do you mean by international financing? So now we have learned how you can obtain funds from different sources. So in international financing, it means that you can borrow funds from funds internationally. Then the organization can raise funds internationally because the business have become global. Then the thing is that you can have access to global capital market, so you can raise funds from this global capital market, international capital market. You can borrow funds. The first one is commercial banks. Commercial banks all over the world extend foreign currency loans for business purposes. They provide foreign currency loans, that is you can avail loan from another country in their currency. So sometimes the thing is that the positive side is that their currency in our country will have higher value, so that is beneficial. So you can avail loan from foreign countries for the purpose of doing business. Then they are an important source of financing, not trade, international operation. The type of loans and services provided by banks vary from country to country, because one country will be having some other rule and the other country will having a different one, so it varies. Next is foreign currency convertible bonds. That means these foreign currency convertible bonds are linked with debt securities that are to be converted into equity or deposit received after a specific period. That is, such kinds of bonds can be converted into equity or deposit received after a specific period. Such kinds of bonds are known as foreign currency convertible bonds. The holder of foreign currency convertible holds the option of either converting them to equity share at a predetermined price or exchange rate, or retaining the bonds. That is, at the price which is accepted today, they can avail it in the future at today's price. So that is predetermined price or exchange rate. So that it has the option. The holder has the option to convert it into equity shares at a predetermined price. Now coming to the last section, that is the factors affecting the choice of fund. What are the factors that are affecting the sources of fund? There are some limitations or factors that affect when you raise funds. First one is cost. You have to look at how much cost is involved in procuring the fund. If it is low, then it can be easily available. If it is high, then it will be having a risk element. So cost of procurement of funds, cost of utilizing the fund, both these costs should be taken into account. This is financial strength and stability. Then how much stable your operations are. The financial strength of business is a key determinant. In choice of source of fund, business should be in a sound financial position to repay the amount, that it should be in a good position that it will be able to repay the amount. Next is form of organization. Form of business organization and status influence choice. Partnership firm cannot raise money by issue of equity shares, as these can be issued only by joint stock companies. Certain forms of organization will have to depend upon specific sources of fund. In purpose and time period, business should plan for which amount means which period, for what period, how much time do you need the amount, within how many period you can repay it. So all these have to be, the time and purpose should be taken into consideration. The risk profile, then if you are able to, you have to check whether the business is able to bear risk. If it is able to bear low risk, it have to avail fund accordingly. If it has the capacity to bear high risk, then it can take sources of fund from those which is suitable. Next is control. The particular source of fund may be affect the control and power of owners on the management of a issue of equity shares may mean dilution of control. That is, you should not have dilution in your ownership. So the control should not be decentralized. So you have to look at those sources which will not dilute the control. Next, effect on credit worthiness. The dependence of business on certain sources may affect its credit worthiness in the market. For example, issue of secured debentures may affect the interest of unsecured creditors. So it depends on the effect on the credit worthiness. So it can affect your credit worthiness. So you have to choose the suitable form of source of fund. Next is flexibility and ease. That is, a flexible source of fund should be used. You should have flexibility in using and applying these financial methods. Next is tax benefit. That is, various sources may also be weighted in terms of tax benefit. For example, dividend on preference shares, it's not tax deductible. Interest paid on debentures and loan is tax deductible. So while calculating the tax, the dividend on preference share, you cannot deduct that, so you have to pay tax on that. But in the case of interest paid on debentures and loan, then tax can be deducted. So you will have some benefit also while you are giving tax. So these are the chapter portions we have covered, like the meaning of business finance and the classification of sources of fund, then owners fund, that is on the basis of period, on the basis of generation, internal and external sources, owners fund, borrowed fund. Then the sources of business finance like retained earning, trade credit, factoring, lease financing, public deposit, commercial paper, issue of equity shares and preference shares, then issue of debentures, then availing loan from commercial banks or financial institution or international financing. And at last we discussed about the factors affecting the source of fund. So these are the key areas which you have covered in this chapter.